Good afternoon. This is Hampton Roads Real Estate News for the week of November 10th, 2025. I'm Coach Screw Little with the Home Run Team at Real. The October numbers are in Hampton Roads, and it's a mixed bag. The number of sales in October slipped less than 1% year over year, which is actually good news compared to much of the country. Even more good news, the number of pending sales rose 4.34% compared to last year, which is a positive sign. Home prices were up just slightly from last year at 2.26%, which is about double the national trend. This is good news for sellers because prices are merely keeping pace with inflation, and good news for buyers because it's clear the runaway price hikes of a couple of years ago are over. And with dropping mortgage rates, we may see some relief on overall affordability. New construction sales were down 25% from 2024 after doing well the last couple of months. This is likely at least partially due to developments having closed out over the past year and a lull between new development launches, but it bears watching to see if a trend emerges. Total inventory was up 16.92% over last year, continuing the trend of recent months, and is just a little ahead of inventory growth nationally. While this does mean more choices for buyers, even with falling interest rates, buyers are not returning to the market fast enough to soak up new inventory. This could signal much longer market times overall this winter, and we are seeing that in certain neighborhoods and price points already. Savvy buyers may be able to use this opportunity to get a better deal over the winter ahead of the spring rush. We're also seeing a continued downward trend in the mortgage rate spread, or the difference between mortgage rates and the 10-year Treasury rate. In recent years, the spread has been as high as 3%. Lately, it has come down to about 2.1%, contributing to the decline in mortgage rates. The historical average spread is about 1.7%. That means there isn't a lot of room left for reduction in this metric, and banks may be unwilling to lessen the spread any further. The mortgage spread is driven by risk. In uncertain times in markets, it runs higher to cover higher risk. In the midst of uncertainty regarding jobs, tariffs, AI, the government shutdown, increasing layoffs possible both public and private sectors, record government debt, and record consumer debt, the stability needed to lessen the mortgage spread may be hard to find. Mortgage rates ticked up slightly last week after a month of declines to an average of 6.22%, which is still well below the 50-year average. U.S. household debt hit a record $18.59 trillion last week, making U.S. citizens the most indebted at any time in history. According to Apollo chief economist Torsten Slok, 1 in 4 Americans also now have subprime credit scores below 660. The combination of high debt loads and credit scores below what most banks are looking for suggests that the affordability crisis is more complicated than just high prices, low inventory, and high rates, especially since rates are no longer high by historical standards. Consumers do have a role to play in improving affordability by upgrading their credit and reducing their debt and debt-to-income ratios. The home turnover rate has hit a 30-year low, with just 28 out of every 1,000 homes selling in 2025. Virginia Beach has the best turnover rate in the nation at 35.2 per 1,000 homes selling. As inventory has been growing, buyer activity simply has not kept up. Buyers have remained on the sidelines due to the affordability crisis and home prices continuing to rise due to a lack of affordable inventory. The number of first-time home buyers is also now at a record low, and their age is at an all-time high of 40 years old. According to NAR, this means Americans, by choice or circumstance, are waiting much later to begin their home ownership journey and begin accruing the wealth that comes with it. Repeat buyers are the primary buyers, now with an average age of 62. There are some efforts underway to unfreeze the housing market. Home builders are reportedly having weekly meetings at the White House in an effort by the government to get more homes on the market. President Trump has also proposed a 50-year mortgage, but this plan has been widely criticized on the right and the left. With a 50-year mortgage carried to term on a $400,000 home, the home would cost the buyer an additional $400,000 plus in interest and make the final cost of the home nearly $1.3 million, while reducing the monthly payment less than $300 per month at current rates. If a homeowner wanted to sell after 8 to 12 years, as most do, they would have significantly less equity in the home. This would most impact move-up buyers, buyers moving to more expensive markets, and anyone trying to tap their equity for a loan or line of credit. Additionally, economics tells us that if a 50-year mortgage is used to lower monthly payments, the prices of homes will just rise to recapture the savings, leaving consumers with even higher priced houses and worse mortgages, and less ability to build wealth. Ultimately, a 50-year mortgage would be a significant drag on personal wealth and the overall economy compared to the 30 and 15-year mortgages that are currently standard. This has been Hampton Roads Real Estate News for the weekend of November 10th, 2025. I'm Coach Drew Little with the Home Run Team at Real.